Welcome to the FinTech One-on-One podcast. This is Peter Renton, co-founder of FinTech Nexus and now the CEO of the FinTech consulting company Renton & Co. I've been doing this show since 2013, which makes this the longest running one-on-one interview show in all of FinTech. Thank you so much for joining me on this journey. Now let's get on with the show. This is a special episode of the FinTech One-on-One podcast. It is episode number 500. I had no idea I was going to get to that number when I first started doing this show in 2013, but here we are. And instead of doing a retrospective or looking back at some of the favorite highlights, I wanted to get someone on the show who has been around as long as I have and has really been a trailblazer and leader in the fintech space. So I invited my old friend Gilles Gade, the CEO and co-founder of Cross River Bank, onto this special show. He graciously agreed to the interview. We cover a lot of territory, obviously about what Cross River is doing today and how they've been able to maintain their leadership role in the fintech space and the BaaS space. And we talk about the BaaS crisis at length. Gilles provides his perspective about lessons learned and what's needed and what is not needed as we come out of this crisis. It was a fascinating discussion. Hope you enjoy the show. Welcome back to the podcast, Gilles.
Hi, Peter.
Great to have you back on. It's been almost 9.5 years. You are on in episode 32. And as I said in the introduction, this is episode 500. You've come a long way in the last 9.5 years. So what I'd like to start off with is actually going back to 2008, when you decided to jump into the banking space. Why did you decide to start Cross River back then?
Just seizing the opportunity. Banking debacle, there's definitely a need for a change in the status quo. Consumers were left behind. A lot of people could not put food on the table, and there was just a clear need to not reinvent banking, but to come up with a new way to bank a big swath of the economy or the population that would not served anymore by the banking system.
So, I know you just recently celebrated 16 years. Congratulations.
Thank you. In fintech years, that's actually a lot.
It's like a century, I think.
Exactly.
So when you started the bank, I mean, you've been really successful. You're one of the most, the largest and most respected banks in the fintech space. Where you are today, was that really your vision back in 2008, or what was the vision back then?
No, not at all. The vision was just to try to change the status quo a little bit, one bit at a time, right. just to address some of the concerns of the consumers by helping folks that were innovative, that used technology, and that just wanted to help the consumers as a whole. And we just paired with, a couple of those just to try, to test the waters. Green Sky comes to mind. That was really the first one, that our first foray in the industry. And we just learned a ton from them, like particularly third-party origination of loans and consumer finance and consumer compliance.
Right.
And we just broke our teeth on that relationship. And ultimately, we became, good enough to be able to convince some of the new entrants, like the firms of the world, the upstarts, the Marlets, to trust us with their products and their consumers and their services. And we're one by one, we developed a reputation of being fintech friendly.
Right. And I know we talked about that in the last episode, because and I will link to it in the show notes for people who want to go back in history. The fintech lending space. I mean, when you first got into it,
I remember the first lending.
Yes, I know.
That's number one. That was we're the pioneers.
Yeah, we grew up together in that time period, and it's really been fascinating to watch how things have grown. But I'm curious. I mean, some of the numbers that you shared in your press release for your 16 years are just truly staggering as far as how much lending volume has flowed through Cross River. Maybe you could share a little bit about how you think you've been able to maintain, because it's it's a competitive environment these days, and it even was back then to a lesser extent, but you stuck your flag in the ground. But you've maintained some of these clients now go back a long, long time with you guys in the lending space. How have you been able to maintain that leadership, do you think?
I think that it's if you demonstrate an unwavering commitment to your customer base and an unwavering commitment to consumer protection, those two go in hand, by the way. I think you would manage to convince most of your clients to stay with you. And that goes, it's not only paying lip service to our clients or trying to convince them that we're good guys. It goes much, much deeper than that. It's in times of cycles when there's a downturn, when there are troughs in the economy, then are you going to step up and actually be beholden to that commitment? Or are you going to leave them in the dust and saying, ciao, see you later, we'll come back when things are a little better?
Right.
And we prefer the former, not the latter.
Yep.
And we've demonstrated that through a number of crises already, in 2015, and then COVID hit, and some of our partners were in great difficulty, and the times were uncertain, and we stepped up. We said, we're going to continue buying your loans. We're going to put them on the balance sheet, and because we're committed to making sure that you're going to survive this crisis and the next.
Right.
And through that, we've just built a ton of loyalty. And now they're thinking twice about going somewhere else. Now, that said, the environment is such that we totally understand them having backups and,
Right.
belt suspenders and a bunch of other, risk management practices that they need to have in place because the market demands that.
Yeah. Yeah.
And the regulators demand that. But, we totally understand that, and we want to be part of that solution. But that said, we're still seeing a ton of loyalty where most of the volume that we used to have is still sticking with us.
Right. Right. And that volume, I'm just going to read some numbers here, which I think are really $137 billion in total originations, 94 million loans originated. I mean, that's those are staggering numbers. Across some of the leading players, obviously.
Listen, this is really a pride and joy, to be honest with you, just to know that we managed to help 94 million consumers. I mean, naturally, some are repeat, but to help 94 million unique users in this economy to put food on the table, to afford life, to buy, to invest in their passions. So whatever the case may be, this is the greatest accomplishment of our careers, all right, collectively here at Crossriver.
I'm actually included in that 94 million. I still have a loan outstanding with Cross River.
You mean as a consumer, but you're included, in my mind, you're included as a partner, as a stakeholder, enabling our industry to be very fertile and to continue to thrive, and particularly to be relevant in the eyes of a lot of stakeholders out there.
Well, thank you. Thank you. Well, anyway, tell us a little bit about how you have expanded beyond, you became a leader in the lending space fairly quickly, but how have you expanded that leadership role into other areas?
So it came as a necessity to continue to serve our lending clients. And so it started with a basic ACH product, which we call ACH Manager. We needed to disperse loans in record time. Naturally, that time is of the essence all the time, particularly for borrowers that are in need of funds.
Right.
And just going through a series of funding cycles, like, for example, we had a truncated file for lending approval of, let's say, 2,000 loans. And then we sent one ACH to one bank, another ACH to another, and then they dispersed the funds. Usually the settlement was taking anywhere between 3 to 6 days.
Right.
That is not going to fly in the fintech ecosystem. So we just thought about developing our own ACH capabilities. And then, so we developed it, and it was pretty neat and very API driven, very easy to onboard, very easy to use, dashboarded, good records, and we were off to the races. We really had an ACH product that we thought we could sell to payment clients. Mm-hmm. So we went on a mini roadshow to some of our partners, and particularly some of the big venture capital firms out there, Andreessen Horowitz and Revit Capital and Battery Ventures and a bunch. And they said, well, we have clients that actually could use that product. And so that's how we were introduced by Andreessen and Horowitz to Coinbase in 2014.
Right. Wow.
And then the rest is history. And now we just followed, we followed that mantra, which is take a cue from your clients. because your clients are taking their cues from their consumers.
Mm-hmm.
So the consumers want something. The client are saying, we will service that something to you because we're listening learners of this industry. And in turn, they're turning to us saying, now you, the bank, has to be also a listening learners of this industry. So please do as, come along to the ride, and hopefully you can actually provide us with the services and the technology that our consumers aspire to be serviced with.
Mm-hmm.
And that's how basically we took our cue from our customers, and we developed from that point on ACH capabilities, push to cards, pull from cards, automated wires, and then ultimately RTP, FedNow. And then fast forward, now we have interoperability of all these systems and services, and particularly RTP and FedNow. And that constituted basically the engine underneath every transaction that we operate, which is what we call in our jargon a core engine, a core processor.
Mm-hmm. Mm-hmm.
So we veered away from our core, which was a traditional core, and into this new core that was native, that was developed by us. And now we have about 350 tech to support it and to continue to develop it into, the 21st century.
And that's how you're able to kind of move pretty quickly into the FedNow and RTP and interoperability, because that's the big piece. I mean, the instant payments piece, it sort of demands interoperability, I would think. But there seems like I don't know many people that are offering that right now.
Right. I mean, that's another thing. We have a little bit of a leg up. We can't stand on our laurels, and
right.
We're seeing the competition is creeping up, but we need to be convincing enough to all our clients that we're the right partner for them today, and hopefully we continue to build that loyalty. And if we deserve to keep those clients, then we'll keep them, and we'll continue serving to serve the consumers.
Right. Okay, so I want to talk about the BaaS, banking as a service crisis, shall we say, that has happened this year, and it's been fairly slow moving. But I was really interested to read your op-ed recently in American Banker, where you kind of laid out the idea that we don't want to overreact to this. We want to encourage innovation, right? Despite the setbacks that's happened here. Maybe you should sort of summarize what the points you were trying to make in that op-ed.
Listen, the regulatory environment is such that it has a tendency to overreact.
Yeah.
In times of crisis. So we did have a liquidity crisis a year ago,
mm-hmm.
where people got caught off guard for a very rapid rise in interest rates. Their balance sheets turned out to be on the wrong side of that risk management. And then ultimately that created a liquidity crisis whereby a lot of the folks out there just exited those banks' relationships.
Right.
And they could not meet up with that demand of cash outflows. So then suddenly the regulators are reaching out to all the banks, and particularly the ones that are perceived to have riskier deposits. And the first that come to mind are the BaaS banks.
Right.
So the increase in scrutiny is not necessarily justified, because I could say exactly the opposite. Actually, as a matter of fact, broker deposits or BaaS deposits are extremely steady.
Right.
And these relationships that you're developing are not the same than the definition of broker deposits from the 1970s when the rule was actually enacted.
Right.
So these are the type of things that we're just asking to open your eyes, just sit at the table, formulate an agenda, and let's talk about it. And there might be a better solution for the consumers out there, because we have demonstrated that BaaS and fintech in general have a ton of validity, and particularly it's here to stay. It's not going anywhere.
Right.
Now it became, the fabric of this economy. So we can't just do away with it by eliminating some of the actors, which are called, fintech banks or BaaS banks. They're in the middle. Where are those consumers going to go? And that is really a key question that all of us, all stakeholders, needs to ask ourselves.
Right.
They're not going back to Wells Fargo or to CD or B of A or any others.
Right.
Because they wanted to taste the flavor of something different, something fresh,
mm-hmm.
something that answers to their aspirations, that they don't feel they're entrenched in the banking relationship, almost prisoners to that banking relationship. And they want to be free-willing. They want to be able to jump from one transaction to the next and have the fluidity of money so that it could actually continue to afford life. And because they experienced the times when that liquidity actually disappeared. or that lending outfit disappeared. So they don't want to go back to those times.
Right. There are consumers, even as we're recording this, that are still frozen out from their money. I mean, that's something that regulators are not going to not take any action, right? I mean, they're already taken some action, but I mean, how do you ensure that something like that doesn't happen again? You know, the regulators obviously didn't prevent this. How could it be prevented again?
Listen, I always look to get answers. There are two types of answers to every problem. There's the cause and the excuse, right? And a lot of people like to find themselves or hide themselves behind an excuse because, first of all, it's very convenient. And number two, you don't have to address the cause, which might be costlier.
Right.
And then you have others who actually are addressing the cause, straight on, because if you eliminate the cause, then you eliminate the effects forever.
Mm-hmm.
So in the case of, the liquidity crisis from a year ago, people like to assign that liquidity crisis to some of the fintech players, or the ones that are going to be the most impacted by a change in regulation or enhanced scrutiny are going to be the BaaS players, ultimately. And this is where we need to differentiate between an excuse and a cause. What caused the crisis? Is it fintech? Is it the democratization of banking services? I don't think so. It was a liquidity crisis due to a very fast increase in interest rates and very poor risk management. So let's address the problem where it lies, which is risk management.
Right.
You want to increase risk management practices? Go for it. But do not destroy innovation or stifle innovation, because that's actually the low-hanging fruit excuse to attack and the easiest way to attack, because those banks are weak, those banks are young, and they're only hanging their hat on one type of business, which is the technology business, the BaaS business.
Right.
That's the danger that is looming here. And that may stifle innovation. We may fall on the other side of the competition because the competition from overseas is looming. And there are many banks who have the wherewithal to come into the US and then, steal the show.
Mm-hmm.
So we have to be very careful with the regulation ends up. This is something that I was trying to bring at the forefront in my op-ed. And I'm not the only one saying this. I mean, obviously, there are a lot of folks being, rallying behind that echo.
Right. The crisis that's happening this year that's still unfolding, it's not directly related to the SVB liquidity crisis. You've got an interesting perch here as someone who is really, running a bank that has, I don't know, maybe you've got more clients than most in the space, and you've been doing this a long, long time. What are the lessons from this particular crisis of the last 3 months? What are the lessons that we can learn from that?
That's a great question. And it's something that we owe to ask ourselves constantly.
Right.
I mean, in general, it's good practice to reinvent yourself and not to take anything for granted. And particularly, you have to constantly demonstrate humility in approaching this market and the regulatory environment, because our consumers and customers deserve that. In this case, the lessons learned, first and foremost, they have to be that consumer protection is what matters the most. And because they expect that, they deserve better, and they're the weakest link in this entire economy. They're the ones who know the least about our products and services.
Mm-hmm.
So they're the first ones to fall prey to bad agents who will abuse the consumers, and we're the last line of defense to prevent that from happening. So it is our responsibility. Every loan is our loan. Every payment is our payment. Every bad actor is our bad actor, and we need to squash them before they spread their tentacles throughout the market. So this is really a lesson that continuously needs to be learned. The second one is, again, be beholden to your clients. If your clients are experiencing difficulty, help them out, because the consumers expect for you to step up, in bad times as well as in good times. When we were very happy to make money during the COVID period, because there was a bonanza in online transactions, because nobody was going to the shop, to the stores to shop. So suddenly, the folks like all the BNPL players, as well as some of the traditional, I mean, I call them traditional, but they're the 2008 to 2012 traditional players such as Marlet, Firm, Upstart, Upgrade, Lending USA, and many others. Lending Club, Prosper. So all these folks, they saw a resurgence in volume and particularly good business because people had the cash, they had the government handouts. Now, what we need to and that's the third lesson that we need to learn, is that consumer behaviors are not dictated by one particular event, because that event could turn out to be a disaster for them. And that's why, affordability of credit is so important. And so that's where technology actually comes into play. Mm-hmm. The use of AI and the use of predictability of consumer behaviors is extremely important in providing the right loan to the right person at the right time. And we saw during that time that there was definitely an outlier in the economy. So are you going to rush to lending an individual an excessive loan because at that time he could demonstrate that he has the wherewithal to repay that loan? But ultimately, that outlier is one little uptick in the lifetime of that individual, and that needs to be taken into consideration. And the traditional methodologies of providing credit to consumers do not work in those kind of cases, mm-hmm. like the FICO scores, like the traditional underwriting standards, like the DTI, the debt to income ratio. All these need to be revisited. And that's where technology comes into play. It's actually to help the consumers, not to the detriment of the consumers. And this is something that the regulatory environment needs to start embracing.
Right. There's a lot of great ideas still. I mean, obviously, fintech is rife with innovation, new companies starting all the time. But what I'm concerned about is you might have had a new company starting up, maybe raised $500,000 or $1 million from friends and family and, enough to kind of get them on their way, and they're looking for a partner bank. And you must get a lot of these types of people over the years. I'm worried that they're not going to be able to be served anymore. I say, right, you really need $10 million to come talk to us, and they can't really get a viable product out the door. Are you concerned about that, where suddenly some of the great ideas have to be better funded to work with a BaaS bank than they would have been 5 years ago?
So that's an interesting point. And I think that the market has evolved. You see some of the folks that used to provide an interface or a set of APIs, or what we call the middleware. So those folks now are changing their business model into a SaaS model.
Right.
They become a software company.
Mm-hmm.
So now suddenly they're a vendor like any others. You have, BSA AML compliance vendors, you have traditional compliance vendors, and you have technology vendors, you have core processing engine vendors. So, and then in the middle, you're going to have a vendor that enables you to do fintech, to do BaaS, to open accounts in a rapid fashion, and all this with your compliance regimen that you have at your disposal. So the market has evolved. I think the same $1 million could actually help innovation, but in a totally different way. And this is the beauty about technology, is that now those banks that used to be, like 20 years ago, 90% of the banks did not have an internet application, a phone app, forget about that, for sure. But even a website, to open accounts online, or to check your balances, or to do transactions. And then that evolved in a way that was open only to a very select few banks in the country. And then that became an off-the-shelf technology, because some folks actually developed that technology to enable you to have access to those services. Those companies did not disappear. Those companies continuously, reinvent themselves. And then there are some new players that came into the fray. Mm-hmm. So that is a demonstrative that, the banking industry as a whole, with the 5,000 banks, 4,000 credit unions in the United States, there's a lot of resilience in that, because the consumer still wants to be able to walk into a branch and talk to somebody, or at the same time conduct an online transaction or a transaction on their iPhone. Mm-hmm. Mm-hmm. So the combination of all these things actually helps innovation. It helps the banks embrace innovation.
Indeed. So I want to switch gears a little bit and talk about your new or relatively new investment bank. You started an investment bank, I think it was just earlier this year, right? And what were you thinking there? What was behind that decision?
It's along the same lines as building loyalty and helping our customers get to where they need to be, so that they could focus on innovation, they could focus on serving their consumers, and we'll take care of the rest. So we do have a capital markets activity, which is extremely robust and very active. So we like to provide capital markets as a service. And then an extension of that is we'd like to raise capital, we'd like to raise debt, equity, structured finance. So we'd like to do an M&A transaction whatever the case may be. And we were short on providing those services.
Mm-hmm.
So Ben Samuels and Harry Pennell founded this investment bank about 6 months ago, and they're off to the races. It's incredible. The reception that we got, I mean, obviously, I don't want to say we benefited because that's an unfortunate term, but at the same time that SVB, it didn't turn out well for them, that's when we benefited because there was a void in the market. There was an entire swath of the market that needed to be served.
Yep.
Now, some of our clients, existing clients, they all have needs in capital, whether it be equity, debt, or structured finance, securitization, and others. That's where we come in. Because we know the company very well, because we're a stakeholder, we have a vested interest in their success. So there's no conflict there. On the contrary, our interests are aligned. So we hand the business over to the investment bank, and they do their thing, and they help them raise capital. But they could actually look at a series of investors and think convincingly, we know those guys. We originate their loans. We effectuate their payments. We know how they behave, and particularly, we know how compliant they are and how serious they are about their consumer base. So this is a dialogue that you could not be able to hold if you were just an investment bank doing a one-off transaction, and not being entrenched with that client.
Yeah, that makes perfect sense.
So it's the same of providing a wholesome service to the client in the full cycle of the product that they cater, whether it be a loan or a payment or an account, like in the case of a BaaS, or transactions such as, a debit, credit, or others.
Can you just give us some stats before we close here? I'd like to kind of get, how big are you guys today? Like, how many employees do you have? What's the assets of the bank?
So the assets of the bank is something that we're managing very carefully. We would like to remain under the $10 billion threshold.
Right.
And we don't want to be at 9.5 billion. We want to be like comfortably below the $10 billion threshold, because there's always growth demands.
Thank you, Dodd-Frank. Yes.
So we're hovering anywhere between 6.5 and 8 billion in assets, which we're pretty comfortable with that. And really depends on the volume of cash coming in at the end of the quarter or exiting the balance sheet. And that's what fluctuates the most. The amount of employees that we have today is, and I'm very proud of that, it's about 1,000 in-house employees and about 300 consultants.
Okay.
We have about 200 people in Israel, and which are all tech, and about 800 here in the country.
Okay.
Most of which are on the East Coast in our office. We have, I believe, something like 500 to 550 people in Fort Lee, and then the rest are scattered across the country. And then we have the investment bank, and we operate out of our own office space, our own building in Fort Lee, New Jersey, and I invite anybody to come and visit. It's really a fintech environment, and we offer a lot of amenities and benefits to our employees that we're very proud to provide. So all in all, top line growth has been very robust at about anywhere between 15 to 35% over the past 5 years.
Right. Okay.
There's a little bit of pressure on the expense side, which is, I think, everybody's experiencing, and particularly as we continue to invest in our regulatory compliance framework. Mm-hmm. And this is something that we will not hesitate 1 second in spending whatever it needs in order for us to attain the gold standard of regulatory compliance.
Right.
So it's a huge investment, and particularly we just take our cue from the various consent orders that have been enacted, the various the scrutiny that we are aware of, the hot buttons that we know of that the regulators are particularly pressing, and we're trying to double down in those areas. We want to be extremely robust so that we could withstand, any scrutiny, and because we do want and aspire to be the gold standard in this industry.
Right. Okay, well, that's a good place to leave it. Gilles, I really appreciate you coming on the show. Thank you for joining me for episode 500, and best of luck to you.
Thank you.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice, and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.